Welcome to This Explainer. Today, we're diving into the absolute ultimate battle of dividend royalty. We're going to discover exactly which class of stocks builds the most wealth over time. Is it the aristocrats or the kings? Let's break down the mechanics of these powerhouse categories.
So, 25 years or 50 years? At first glance, the choice seems completely obvious, right? More years of dividend growth should automatically equal better returns. But as we start to unpack the criteria for these two categories, the nuances reveal a much more complex wealth creation strategy. 50 plus. Honestly, it's a staggering number when you really stop and think about it. Think of all the market crashes, the crazy inflation spikes, recessions, all the global events that have shaken up the world over the last half-century. Achieving more than 50 consecutive years of dividend increases, that highlights exactly why this level of dividend growth investing has become so incredibly popular for long-term wealth creation. It's literally the ultimate stress test for a business. Okay, here's our roadmap for today. We'll cover the quest for dividend royalty, defining aristocrats and kings, a head-to-head comparison, building your investing strategy, avoiding common dividend mistakes, and finally, our key takeaways. Let's jump right into defining aristocrats and kings and look at the criteria for dividend royalty. First up, the Dividend Aristocrats. By definition, these are S&P 500 companies with a minimum of 25 consecutive years of dividend increases. And you've got to note the word increases there. It's not just about paying a dividend, it's about raising it every single year for 2.5 decades. Aristocrats are these financially strong giants offering a fantastic balance of growth and reliability. But, that strict S&P 500 requirement can sometimes be a bit of a double-edged sword because it limits the pool of available companies and actually leaves out some truly incredible international or mid-cap businesses. Now look at the contrast here. Dividend Kings are companies with a minimum of 50 consecutive years of dividend increases. But, and this is key, S&P 500 membership is completely optional. Kings achieve an extremely rare 50-year streak, which makes them the most admired companies by long-term investors. And because they don't have to be in the S&P 500, you'll sometimes find slightly smaller, maybe lesser-known companies in this category that have just been quietly compounding wealth in the background for decades. All right, moving on to our head-to-head comparison, aristocrats versus kings.
When we put these metrics side by side, we see a really distinct trade-off. While aristocrats boast 25-plus years of growth and high stability, they generally offer slightly higher growth potential than kings. Why is that? Well, a company that's been raising dividends for 25 years might actually still be in a phase of dynamic market expansion. On the flip side, the kings, with their 50-plus years, offer extreme stability and just unmatched recession reliability. A company paying out for 50 years has survived literally everything the economy can throw at it. But because they are so mature, their growth potential might just be moderate. It's that classic trade-off, right? Growth versus ultimate defense.
Next up, building your investing strategy. Let's talk performance and portfolios. The mechanics of wealth creation with these stocks go way beyond just, collecting a check in the mail. We're looking at historical resilience during market crashes. When the market drops, these companies usually just keep paying, which lets investors utilize dividend reinvestment. And when you reinvest those dividends at lower stock prices, you absolutely supercharge your compounding returns. Plus, because these payouts increase every year, they offer excellent inflation protection. The absolute most vital takeaway here is that increasing dividends matter way more than just a high starting yield. Seriously, a 2% yield that grows 10% a year is eventually going to crush a stagnant 6% yield. So who should buy what? Well, aristocrats are great for young investors and long-term wealth builders who want a solid balance of growth alongside their income. Kings, conversely, are ideal for retirement portfolios, conservative allocations, and passive income seekers who prioritize absolute safety above all else. But honestly, why choose just one? In practice, a lot of successful investors actually hold both. They blend the dynamic growth potential of aristocrats with the absolute, unshakable consistency of kings to create a really well-rounded portfolio. Okay, let's get into avoiding common dividend mistakes, so you don't let your portfolio get dethroned. If you really want to completely jeopardize your investments, just follow these ironic steps. Number 1, chase only high dividend yields. A sky-high yield is often a massive red flag that the market is expecting a dividend cut. Number 2, ignore payout ratios and earnings growth. Yield is completely meaningless if free cash flow and EPS growth can't safely cover those dividend distributions over the long term. Number 3, ignore debt and skip valuation analysis. Listen, even a king can be a terrible investment if you buy it at a massively overvalued price, or if they've taken on way too much debt just to fund their payouts. And finally, assuming every dividend stock is 100% safe. No stock, and I mean no stock, is immune to fundamental business failure. You still got to do your homework.
Let's wrap things up with our key takeaways and talk about the long game.
So here's your final summary. Dividend Aristocrats offer an excellent balance of growth and reliability. Dividend Kings, they represent exceptional consistency that's been proven over decades. But remember, neither category guarantees future returns. Just because a company has done it for 50 years doesn't guarantee year 51. Success relies entirely on picking quality businesses, staying diversified across different sectors, and having immense patience rather than trying to perfectly time the market's ups and downs.
I'm going to leave you with this final, really powerful thought. The best dividend portfolio isn't built overnight. It's built through decades of owning quality companies that consistently reward shareholders. It's all about letting time and compounding do the heavy lifting for you. So keeping that in mind, how are you going to construct your portfolio for the decades to come? Are you going to favor the growth of the aristocrats, the unmatched safety of the kings, or maybe a balanced blend of both? Thanks so much for joining me on this explainer, and happy investing.